Putin invades Ukraine, sending shockwaves across markets. Equities knee-jerk lower, but recover quickly, whilst commodities such as oil and wheat rip higher on supply concerns. Meanwhile, rates markets price out some hikes ahead of Powell's testimony this week. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Today is the 1st of March, and let's take a look at these markets. So geopolitics obviously has been, once again dominating the market. Everyone's worst fears were realized on Wednesday, last Wednesday night, as Putin invaded Ukraine. And the US has actually been warning about it for weeks. It's just people have become accustomed to think Biden doesn't know what the hell he's on about, or he's got some other agendas and stuff. And obviously lots of experts around last week saying it wasn't going to happen and it was all a game of chess and all this stuff. They all turned out to not have a clue what they were talking about, clearly, right? So Putin had other ideas and he went in anyway. Now, asset prices obviously had enormous swings, with equities, obviously, and crypto knee-jerking lower. And commodities such as oil, gold, wheat exploding higher. So the chart on the left, we can see things are kind of trading around, doing their thing, and then you get this massive asset price dispersion with commodities flying and the other risk assets selling off. Right now, those moves were unwound pretty quickly, as it seemed that the sanctions would not be extreme as first thought. That was last week. And then Biden had confirmed that US troops would not be fighting in Ukraine. So market took some solace in that and then went on to recover. Okay. Now, since then, obviously, the sanctions have ramped up, right? So over the weekend, sanctions have been ramped up with some, major Russian banks, including the Russian central bank, exclusion from SWIFT, and the ruble completely collapsing, right? More than 20%. There was some print at like 50% at the weekend, apparently. Now, Russia holds, $300 billion in foreign currency offshore. And people like Zoltan Pozsar have been, suggesting like a Lehman moment where, money markets freeze up and you get a hell of a lot of disruption. So that still is a potential tail risk there. Which may need, the Fed to step in and provide liquidity and things like that. So that's something that kind of needs to keep an eye on. And dollar funding markets have started to show some stress around that as well. Oil and gold obviously spiked as it seemed likely that Russian oil supplies would be inaccessible. And so pressure is on the governments to, tap their SPR reserves to avoid a major price spike. So I think that really we've got whilst oil is trading up, clearly, some may have thought we would have seen a more aggressive spike. And it seems that the SPR release and the idea that Iran talks are ongoing and they may be able to provide some supply to the market, that's keeping oil from absolutely going nuts right now. But it is still pretty high, right, clearly. Now, Russia-Ukraine held talks at the Belarus border yesterday. They're likely to hold talks again later this week. And we don't know how Russia's going to retaliate on energy supplies, right? So obviously Europe finally, was okay with the SWIFT expulsion, and kind of Russia's got Europe over the barrel a little bit on natural gas, right? So yet to see how that's going to play out. Obviously, Russian asset prices have gone nuts. We said about the ruble, they had to take their interest rate to 20% to try and stop capital sort of leaving. The Russian 5-year CDS has gone to, 20-year highs, that type of stuff. So crazy things going on in those markets, as you'd expect. Stocks, however, rebound, obviously. So looking back at previous wars, it typically pays to buy the invasion, right? A lot of people have put out some stuff around this, looking back at Vietnam War, Gulf War, Afghan War, Iraq War, Crimea crisis. And if you look 12 to 18 months out, generally the invasion was a buy, right? So seeing stocks knee-jerk lower and then rebound pretty damn quickly shouldn't be overly surprising, given that that is the sort of typical price action we do tend to see, right? Last week, all the US major indices recovered their losses. Europe and EM were lagging, as you would kind of expect. Powell is speaking this week. That will give markets an idea on the level of aggression in terms of rate hikes in the face of this geopolitical uncertainty, right? The market has got used to Fed, being there, saying things, we're monitoring the situation on the ground, blah, 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 and we'll react accordingly. But the Fed's mandate has changed, right? The latest news is likely going to increase inflationary pressures, which probably bolsters the case for a 50 bip lift-off in March, right, given what the hell prices are doing. So maybe they won't want to react to short-term swings in commodity prices. Typically, they don't like to, but it's not relieving the pressure in terms of inflation, right? So I'm not expecting Powell to say anything particularly rosy and friendly to the market. Not really sure the market even believes he will. So I don't think there'll be a massive downward reaction on what he says. I think everyone kind of is starting to get it now that the Fed needs to do something on rates, and it's going to be hard to kind of divert them from that path, right? In terms of number of hikes, though, the risk off has taken number of hikes being priced from something like 7 back down to 5 and change, right? And it has taken the probability of a 50 bip hike down as well. So market pricing is reflecting a bit of risk off in terms of fixed income, but I think people are starting to get comfortable with the idea that the Fed's mandate is about inflation now, and that isn't about to change anytime soon. If we then look at equity price action, knee-jerk lower down to 4,100 on the S&P last week. Obviously, strong reversal that we often see on panic days. You get these hammer candles, or doji candles as they're called, where you get this massive wick down and the market actually ends up in the green or close to the green. Nasdaq had a 1,000-point intraday reversal. Apple kind of kissed its 200-day moving average and showed some bullish divergence on the momentum indicators, as did S&P. VIX got close to 40 on the upside intraday last week to end the day at 30. So again, pretty wild intraday moves, but often around that 40 level on VIX seems to be the kind of crescendo of risk off, and then things can kind of heal, right? And that's kind of what we see. So a lot of signs of panic, which makes you feel a bit more comfortable that a flush out might be complete, basically. Now, the major area to overcome on the upside on S&P is going to be around that 44.25, 44.50 area, which is kind of that downtrend resistance. To get any meaningful recovery, like the kind of post-Omicron bounce we've been talking about, you kind of need to get above that hurdle, really, right? And obviously right now, markets are whipping around still on every headline, right? Markets have digested the weekend news flow relatively well, right? And I think it helps that Ukraine and Russia are holding talks, right? And, it does seem like Russian headlines are going to have less and less impact now in terms of like aggressive down moves in spot, unless things turn nuclear, right? And there has been some talk about, Putin talking tough with regards to that. Remains to be seen. That's obviously a very scary thought, and markets are going to get scared if they see those sort of headlines. But right now, market seems to be digesting things okay. Yeah. If we then go over to the options position, so despite some short gamma rolling off on Friday, as Brent kind of pointed out in his notes, markets clearly still remain in short gamma territory. And the part of the reason, and this is what Charlie McGilligan pointed out in his chat with Macro Voices, is that clients seem to be focusing on short-term put options to navigate geopolitical headline risk, because the absolute level of vol is quite high now. So rather than pay up the premium to own 1 month to 3 month put protection, well, clients are just saying, well, I just need super short term, so like 1 week stuff. So weekly seem to be being used quite a lot to protect books. And those have a chunk of gamma on them, basically, right? Which then bleeds away through decay, creates these kind of charm and these Vanna dynamics that we keep seeing, and just the general sort of choppiness because the street is short gamma, right? So that seems to be what's going on. Now, on the downside, the equity hub picture that we've got is suggesting 4100 and 4205 as the support levels. Certainly, that's what Brent's calling for. And on the top side, the core wall resistance is like 44.5, 44.50. Above 44.50 would be required for a more sustainable sell-off in the VIX, as dealers would become longer volatility and some more equilibrium could return to the market. We start to see smaller realized moves as well. Now, we may need to see the back of the March FOMC on the 16th to 18th before that stability can return, right? Either that or a major de-escalation from this Russia crisis, right? From the Ukraine crisis, should we call it. Better economic data is unlikely to provide much boost as it keeps the pressure on the Fed for more aggressive tightening, right? So we're seeing, economic surprise indices are pretty high. That means data is coming out good, and that's not really going to help spot prices and the broad indices right now, because that's just going to mean the Fed's going to be as aggressive as they want, basically. Yeah. Now, the thing that maybe might fuel a bit of a rally, which often is the only hope we have, is that there's been so much de-risking, right? So since the start of the year, obviously catalyzed first by Fed tightening and now war, the NASDAQ positioning has dipped into negative territory, right? So this is a measure by Deutsche Bank, asset allocation. They're looking at CFTC data, and they're seeing futures in leverage funds and asset managers' futures positions on the NASDAQ have turned net short, okay? So that's pretty significant. And then, seasonals also, if you look at the seasonals here on the left-hand side, post-February, the seasonals kind of turn up. So there may be a pain trade higher to kick in if we go on that. And then obviously here you've got US equity long-short delta has been massively cleaned out as well, okay? So I would say be careful getting over your skis bearish with the current setup, right? It's not, it's an obvious, everyone's nervous, everyone's shitting themselves. Often that's fuel for a squeeze rather than anything else, okay? If you have to own downside, if you have to be short, probably 3 to 6 month put spreads are a safer way if you have to own protection. I think they'll probably go down in value, but if you have to have something on, that's probably the way I would structure it, right? I personally think we've got a bit of a rally coming into sort of Easter, and then I'll be using any rally like that to get quite bearish, probably, or certainly to put on some protection. But right now, I'm not running to buy protection. Okay, then if we move over to commodities. Oil not spiking as much as you might expect on some of the recent headlines. Like I said, SPR reserve releasing barrels onto the market. I think it's only a short-term fix though, right? They're going to run out of barrels to release, right, if things stay like this. So at some point, they're either going to need the Iranian barrels or they're going to need the Russian barrels coming back, right? So this is going to be an interesting dynamic, and hard to see sustained downside in oil, right? So watch out for that. Natural gas prices in Europe are obviously a huge worry. They spiked as much as 35% over the weekend. It's just not sustainable for Europe, and it kind of risks throwing Europe into a recession should things get worse. Germany's increased its defense budget as well, finally accepting that they need, and they're finally accepting they need more energy independence. Right, so things like nuclear are going to feature. I mean, if you look at what uranium did yesterday, it ripped 6% higher or something like that, right? So, these energy markets are going crazy, but Germany's going to have to, accept that they don't want to be so exposed to Russian energy. Now, obviously, gold's the other big one. Had a mini spike over the weekend as well, but got faded super fast. And people are talking about the idea that Russia, who's been hoarding gold for ages, may need to tap into that and sell some gold to kind of release some liquidity, okay? Now, it doesn't seem like they've done that yet, and gold's rallying again today. But that is an idea that's been thrown around, which may basically keep a lid on what gold does in the face of this latest round of geopolitical tension. Yeah, that could lead to some interesting price action in gold, where you might see the safe haven not behaving like a safe haven if Russia do end up having to sell a chunk, right? So kind of be wary of that, I would say. I already took profit on my gold calls last week on that spike up to 1960. That was a bit of a resistance level for me. So I took that opportunity to just flip those out. I took half of them off too early, around 3.5x, and then that last clip was at like 7x. So I was more than happy with that return on those calls. And then this chart here just talks about commodities in general, right? So you've got this record backwardation tightness across all commodity markets as a measure of, and then measuring it via annual backwardation rates, which remain at record levels, right? So, haven't seen that in 15 years. Yeah. Now that has been a good, holding real assets has been a good long-term in your long-term portfolio has been very beneficial, clearly, right? As a diversifier against inflation risks. Been talking about that, for a while, holding things like copper, nickel, a little bit of gold, things like that in the portfolio for the long term, because there's a structural story there on the demand side, but just in general, wanting some real assets there, because bonds don't help you much in that inflation scenario, whereas these commodities do. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.